Hi, today I wanted to share some information regarding mortgage rates for 2026 and where some of the predictions are for where we will be later this year, not necessarily right now, but later this year and by the end of the year. And so let me start by saying I've talked about this in the past, but I want to reiterate it here. When the Federal Reserve meets, and they meet 8 times a year, and determine what they're going to do with regards to short-term rates, that the Fed funds rate to be specific, they will meet, and if they lower it by a quarter point or lower it by a half point, that's going to have a direct impact on things that are more short-term. So thinking along the lines of prime rate, that's probably the one that stands out the most. So prime has a lot of home equities tied to it, credit cards tied to it, business loans, etc. And so when the Federal Reserve meets and they cut by a quarter point, for example, the very next day prime adjusts by that same quarter point, and there's an immediate impact with any of those types of loans. Mortgage rates, on the other hand, are long-term rates and therefore are not directly impacted by what the Fed does, but they are influenced, if you will, by what the Fed does. So it's very important to have that distinction, because I'll have a lot of clients that will see that the Federal Reserve has cut by a quarter point and then automatically assume mortgage rates have come down by that same quarter percent. And again, it just doesn't quite work that way. But what's going to allow the Fed to continue to either lower rates or keep them the same is going to be what's going on with regards to the economy. So specifically, inflation, the jobs market, unemployment, etc. Those are the things that they're keeping an eye on to make sure that those are all trending in the right direction. If those are all trending in the right direction, again, the Fed making those cuts will definitely impact mortgage rates. So let's just talk about a few of the things that will impact mortgages, and specifically when the Fed is looking to potentially cut or not cut. So the Federal Reserve, for example, when it comes to inflation, they look at their favorite measure is what's referred to as PCE, or personal consumption expenditure. Now, the most recent reading on that is around 2.8%. Many of the Federal Reserve members anticipate that being down to 2.4 by the end of the year. So it's still above their target rate of 2%, but many of the Fed members see that moving in the right direction and trending downward, which is what we want to see, because the lower inflation is, the better it is for mortgage rates. Now, there are economists out there that are anticipating that PCE number staying around 2.6 to 2.8. So if inflation does stay higher, it remains kind of sticky, that's going to, hurt the Fed's chances of potentially lowering more, because they don't want to let inflation stay persistent or, worst off, even climb. If that number climbs, that could also be bad for mortgage rates and have a negative impact on them. And then the other thing that the mortgage rates are kind of tied to, if you will, is what's going on with the overall economy with regards to the jobs numbers. So therefore, unemployment, for example, the most recent reading on that came in at 4.4%. Estimates are for that to range anywhere from 4.4 to 4.8 this coming year. The higher that number climbs, the more likely it is the Federal Reserve would look to cut rates, therefore, again, impacting mortgage rates and at least having a positive influence on them. So inflation, we want that to come down. That will help mortgage rates come down and the Fed to continue lowering. Unemployment, unfortunately, if that goes up, that'll actually be good for interest rates, because the Federal Reserve will potentially cut to keep that kind of in check and not let that get out of hand. Now, the other thing that is going to have an influence on rates is what happens with regards to, say, the government. If the government continues to, spend money that we don't have, that's going to incur additional debt on a national level. That increase in debt is going to also hamper interest rates and keep them higher than if we don't have that. Now, most recently, on a positive note, the administration announced that they are going to have Fannie Mae and Freddie Mac purchase $200 billion in mortgage-backed securities. That's going to have a positive impact on rates. We're already starting to see it a little bit just, based on the announcement. So that's referred to as quantitative easing, where they're purchasing mortgage-backed securities to kind of keep them down, or at least not allow rates to climb. So that's a good thing for mortgage rates going forward. As far as some of the predictions, we're seeing anything from 5.9% up to 6.4%. So basically in that low to mid 6 range is kind of what most are anticipating. And it averages out to about 6.17 with the various predictions that have been made out there. One outlier, if you will, is MBS Highway, who is ran by Barry Habib, and he is someone who is actually anticipating rates to get as low as potentially 5.7. Now, obviously, that would be great for the housing market, would really help move things along. And so I think in general, we're probably going to be looking at, high 5s to low 6s is probably in all likelihood where we're going to end up for 2026. Now, again, some of the things I mentioned earlier as far as inflation, unemployment, even the quantitative easing that is going to happen, all of those things are going to impact it. And so it's not to say that these numbers are set in stone, but it is something that you can kind of anticipate. And obviously, the lower rates go, the better it is for housing market. It's going to increase demand, which would also be good for the overall market in terms of keeping home values up and not letting them deteriorate in value. Listen, I hope you found this information helpful. And if you did, please do me a favor and subscribe to our page. If you have more questions around interest rates and what's potentially going to happen this year, feel free to reach out, give us a call, text us. We're always here to answer your questions. Have a great day. We'll talk to you soon. Bye-bye.